In the last month or so, we have seen the S&P 500 fall by almost 18%, and there are two very distinct moves. I personally believe that this first move that we saw from February through till March was a move down in correcting valuations. We saw a lot of companies hit in a major way, and their valuations start heading back to normal levels. What we are seeing now is an additional move down that, in my opinion, is starting to bring stocks into undervalued territory. So today we are going to take a look at 3 different companies that have been beaten down over the course of the last year, and we're going to dive into their valuation and how these stocks could rebound in the coming year to provide very nice returns. And if you stick around till the very end of this video, I will show you the moves that I am specifically making in the market right now. So I hope you enjoy. If you do, make sure to drop a like down below and subscribe for more videos like this one. And the first stock that we have up here is AMD. Over the course of the last year, AMD has dropped by almost 50%. It has an all-time high that it achieved back in March of last year of just over $200 per share. And if you aren't familiar, AMD is the number 2 player in data center chips. They are directly behind Nvidia, who is the number 1 player. Nvidia, however, primarily focuses on GPUs, where AMD focuses on both GPUs and CPUs. And in the last quarter, AMD was able to increase their data center revenue by 69% year over year to $3.9 billion. The only downside to this is they are not outcompeting Nvidia. Nvidia over this same quarter was able to increase their data center revenue by 93%. And because of this slightly slower growth, as well as them being the number 2 player in this market, they are trading at a lower valuation in comparison to Nvidia. Right now, Nvidia is trading around a 22 forward P ratio, while AMD is sitting at an 18.45. For me personally right now, I am taking a look at 2026 EPS numbers. I think 2025 will be a very interesting year. However, I don't think it's going to be representative of what companies are going to achieve in the long term, especially with the short-term volatility that we're seeing around tariffs. What that means is for AMD, analysts right now are projecting $6.25 of EPS in 2026. On the low end, it's $4.97, and on the high end, it's a staggering $9.10 of EPS. And in my opinion, I think AMD finally fell into a range where the stock becomes interesting, because even at the underperformed metrics of $4.97 in 2026, we would still have a price target at a 20 forward P ratio of $99. That's well below the current stock price of just under $85 per share. And those are just the underperformed numbers. When we start looking in line at $6.25 of EPS and a P ratio anywhere between a 20 and a 30, we are still talking about almost 50% upside to $125 per share, or over a double up to $187 per share. In my opinion, this outperformed EPS of $9.10 is probably unrealistic with what's going on in the macro economy. But if they were to achieve this over the course of the next year or so, I think they would easily trade at a 30 PE ratio, which could result in a stock price of over $270 per share, which would be over a triple up from the current stock price. And you might ask yourself, why would you buy AMD if Nvidia is trading at a similar valuation of around a 22? In my opinion, the reason to buy AMD is because the business is more diversified. Because they have focused on both CPUs and GPUs, the business is a little bit more equipped to handle tougher situations. If we see a massive pullback in the data center market, Nvidia is going to be hit more significantly than AMD because AMD is a little bit more diversified across their business. The next stock we have up here is Elf Beauty. Elf Beauty hit an all-time high back in June of 2024 of around $220 per share. From that point till now, the stock has fallen by almost 75%. And if you aren't familiar with Elf, they are a beauty and cosmetics company that really prides themselves on having affordable products. They also have focused a lot on social media marketing, which has proven to be a great strategy over the last couple of years. And the reason the stock is down over the course of the last year has to do with relative weakness of their bottom line. They hit a peak for trailing 12-month EPS of $2.26 at the end of 2023. However, over the course of the last 4 quarters, they have consistently seen their 12-month EPS drop, now sitting at a GAAP 12-month EPS of $1.68. However, even with that weakness on their bottom line, they are still able to grow their top line numbers significantly. They have seen year-over-year growth of 31% as of their most recent quarter. That is down quite a bit from the growth that they were seeing back at the end of 2023 of around 85%. And because of this relative weakness on the bottom line, as well as slowing growth of their top line, their valuation has consolidated to a more reasonable level. In the past, they were trading at forward P ratios anywhere between 45 and 60. However, today they have a forward P ratio of around a 14.33. For bottom line projections, we are going to take a look at non-GAAP EPS numbers on Yahoo Finance. The numbers we were just looking at on macro trends are GAAP EPS numbers. So keep that in mind. That's why these numbers look vastly different than what we were just looking at. For 2026, analysts on Yahoo Finance have an average EPS estimate of $3.64, a low estimate of $3.24, and a high estimate of $4. If ELF comes through and puts up some of these numbers, especially the underperform or inline numbers, I think they would trade at a reasonable valuation between a 20 and a 30 PE ratio. What that would result in for underperform of $3.24 is a stock price anywhere from $65 per share to $97 per share. If we see inline performance of $3.64, that could result in a stock price anywhere from $73 per share to $110 per share. If we see the company outperform and put up $4 of EPS, as well as maintain strong revenue growth, anywhere I think between 25 to 45% revenue growth would be a massive thing for ELF. That could result in higher valuations being justified for the company. I think on the low end, we could see valuations between 25 and 35, which would result in a stock price between $100 and $140 per share. So when I look at ELF, it's a very interesting company because even if they underperform and only put up $3.24 of EPS, and let's say over the next couple of years, they're able to justify a valuation of around 20, that still results in a stock price of around $65 per share, which is 20% below the current stock price. The problem for this company is they do get a lot of their products from Asia, specifically China. So they're going to feel the heat with tariffs as well as the effects that this could have on the consumer. The benefit for ELF is that they are one of the lower valued products, which means that if people start trading down from more expensive products, they could actually be trading down to something like ELF. The last company we have up here is a very interesting one. It is actually Target. Target in the last year is down 44%, which is absolutely insane because Target is a very consistent business model. At one point, the stock was trading around $260 per share, but that was back in 2021. From that point till now, the stock has actually fallen by over 60%. And really, this drop in stock price has to do with weakness relative to their bottom and top line numbers. Their top line over the course of the last 2 years has basically been flat. They actually peaked at a top line trailing 12-month revenue of $109 billion. However, today it has fallen slightly down to $106.5 billion. And EPS has had an even worse trend because they peaked at a trailing 12-month EPS back in 2022 of $14.10. However, today that number is down to $8.86. The thing with Target is they are trading at a relatively low valuation. Their forward P ratio is currently sitting at a 10.55, and they have consistently over the past year traded anywhere between a 15 to a 17. Whenever I've bought a company and they've traded around a 10 PE ratio, as long as it wasn't a cyclical business like the oil industry or car companies, I have done very well. And it's not like analysts are projecting EPS numbers to drop over the next couple of years. For 2027, their average EPS estimate is $9.83. They have a low estimate of $7.48 and a high estimate of $10.80. And when you start getting to valuations around 10, there's a lot of opportunity just for valuation expansion. When we think about Target, even if they put up any of these numbers, $7.48, $9.83, or $10.80, we are still talking about the potential of the valuation expanding to around a 15. That seems reasonable for a company like Target. And in all of these cases, we are talking about an increase in the stock price, whether it's 20% on the low end or all the way up to 70% on the high end. And if the valuation expands to the higher end of around a 20 forward P ratio, you're now talking about upside anywhere between 50% to easily a double up in the stock price. So let's go ahead and take a look at the YouTube portfolio. We are currently sitting at a value of $54,436.09. We are down from an all-time high of around $66,000 back in February. And this is what our current positions look like in the YouTube portfolio. We are currently down actually on 3 positions: Google, Super Microcomputer, and PayPal. We're very close to being in the red on Microsoft as well, up only 0.4%. We also hold SoFi, Alibaba, Visa, Apple, and Palantir. The moves I've been making in the market have primarily been around big tech, and specifically in the realm of Google and Microsoft. I've added a lot to my Google position. This to me is the most undervalued stock right now in the market. Google is a company that consistently is growing their top and bottom line, and I think right now the market is severely undervaluing what Google is truly worth. I could see them over the course of the next 5 years expanding not only on their top and bottom line numbers, but also expanding in terms of their valuation. And that's why I've added so aggressively to this position. So what I've done in the last month or so is I've paid very close attention to large tech companies. Think about the Meg 7, think about Google, Microsoft, Amazon, Apple, Meta, all those types of companies I have been paying close attention to because you don't often get them at low valuations. And what we have seen initially is pullbacks in those large tech companies. However, what I think is going to happen next is we will see larger pullbacks from smaller companies because a lot of these smaller companies have traded at rich valuations over the course of the last year or so, and they have a lot more room to fall. I think we're just now seeing them reach more reasonable valuations. As we continue to see them fall, I think they could become severely undervalued. Out of the 3 companies that I talked about today, the one that I am most interested in is AMD. What I see playing out over the next couple of months is I think we will go into earnings season and see a lot of companies talking about potential pullbacks in their EPS numbers and providing relatively weak guidance moving forward. What that could result in is further declines in stock prices, and ultimately I think that could hurt AMD in a major way because a lot of these large tech companies could start pulling back on some of their spend around data centers. However, this could ultimately lead to the Fed lowering interest rates, which could actually cause these big tech companies to reinvest into their business very heavily at lower interest rates. And this could help AMD over the next 2 to 3 years. And if we see all of this play out, I have plenty of cash on the sidelines to capitalize on it, as well as potentially selling out of SCHD to bring more cash into individual stocks. But keep in mind, that is all just my opinion. Don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day. And for the joke of the day, what do French hedgehogs see on Groundhog Day? Check the comments down below for the answer. Thanks for watching.